You walk into your bank one day to check on your savings account, and suddenly you are told you owe fees on a credit card you never applied for. Or maybe you get hit with overdraft charges because money mysteriously disappeared from your checking account. Sounds like a nightmare, right? Well, for millions of Americans, this was not just a bad dream. It was reality. And the bank doing this? Wells Fargo, one of the biggest, most trusted names in American banking. We are talking about over 3.5 million fake accounts. 3.5 million. That is not a typo. These accounts were opened without people knowing, without their permission, and sometimes even without them setting foot in a bank. And the wildest part? This did not happen overnight. It went on for over a decade, from 2002 to 2016, right under everyone's noses. So, how does something like this even happen? How does a bank, a place where you are supposed to trust your money, end up stealing from its own customers? And more importantly, why did thousands of employees feel like they had no choice but to commit fraud just to keep their jobs? Stick around, because what you are about to hear is not just a story about a company gone wrong. It is about regular people who got crushed, employees who were terrorized into cheating, and executives who walked away with millions while everyone else paid the price. Let us rewind to understand how this whole mess started. Wells Fargo has been around since 1852. By the 2000s, they had become one of the biggest banks in America, over $1.9 trillion in assets. They survived the 2008 financial crisis when other banks were collapsing. They even bought out a failing bank called Wachovia. People saw them as stable, trustworthy, and the good guys of banking. But behind the scenes, there was this massive push for something called cross-selling. Now, cross-selling is not inherently evil. It is basically when a bank tries to get you to use more of their services. You have got a checking account? Great. How about a savings account too? Maybe a credit card, a mortgage, that kind of thing. The guy who really pushed this strategy was Richard Kovacevic, who ran Wells Fargo for years. He came up with this whole philosophy that customers were not really clients, they were consumers, and bank employees? They were not there to help you manage your money. They were salespeople. He literally said this in interviews. Kovacevic came up with this catchy slogan, going for grade 8. Get it? 8 products per customer. That was the goal. 8 different accounts or services for every single person who walked through the door. The company even had this mantra, 8 is great. Now, here is the thing. For most regular people, do you really need 8 different financial products from one bank? Maybe you have got a checking account, a savings account, and a credit card. That is 3. Getting to 8 means you would need things like a second credit card, a line of credit, online bill pay, maybe a money market account, and investment accounts. Most people do not need all that stuff. But Wells Fargo did not care if you needed it or not. They wanted those numbers, and they were willing to do whatever it took to get them. So how did Wells Fargo actually motivate their employees to hit these insane sales targets? Through a system that would make a used car dealership look tame. First, they set up these wild quotas. Former employees who worked at Wells Fargo between 2004 and 2016 described it as hell. One guy called it a grindhouse. Another said it was the lowest point of my life. People were having panic attacks. They were throwing up from stress. Some were crying at work. Every single day started with a huddle where managers would grill employees about their sales numbers. Where are you at? What have you got going? How are you going to get there? And they would just keep repeating that last question over and over. How are you going to get there? The daily sales goals were brutal. On a normal day, you might be expected to sell 8 products. 8 different accounts or services every single day. And these were not to different customers, remember. They wanted 8 products per customer. So you would have to convince someone who came in to open a checking account that they also needed 6 or 7 other things they probably did not want. But it got worse. During special sales pushes like this thing called Jump into January, the quota jumped to 20 products a day. 20. In an 8-hour workday, that is more than 2 sales every single hour. If your branch did not hit its targets, the shortfall got added to the next day's goals. So you would start the next day already in the hole, trying to dig yourself out while also hitting that day's numbers. And the compensation system made it even more intense. Personal bankers could earn bonuses worth 15 to 20% of their salary. Tellers could get up to 3%. That might not sound like much, but when you are making maybe $30,000 or $40,000 a year, an extra few $1,000s matters. But here is the flip side. If you did not hit your numbers, you would get written up. You would get put on a performance improvement plan. Managers would start documenting every little thing you did wrong. You would be called into meetings and pressured, and eventually, you would get fired. One former employee put it this way: if you do not meet your solutions, you are not a team player. If you are bringing down the team, then you will be fired, and it will be on your permanent record. Another said, we were all miserable, and it was just soul-crushing to walk in every day. So employees were trapped. In a tough economy, especially after 2008, people were terrified of losing their jobs. Some had families to support, mortgages to pay, and kids to feed. And their bosses were telling them, hit these impossible numbers or you are out. When you cannot meet impossible goals through legitimate means, something has got to give. And at Wells Fargo, what was given was ethics. Employees started opening fake accounts, lots of them, and they got creative about it. Here is how it worked. Let us say you are a customer who walks in to open a simple checking account. The employee would help you fill out that paperwork. But then, without telling you, they would also fill out applications for a savings account, a credit card, a line of credit, online banking, bill pay services, whatever they could think of. They would forge your signature on the applications. They would make up email addresses for you, like your name plus some random numbers at Gmail. They would create PINs for debit cards you never asked for. They would activate credit cards and then hide them in a drawer so you would never see them. Sometimes they would move money around between your accounts in something they called simulated funding. Say you had a checking account with $2,000. They would transfer $500 to a new savings account they had opened without telling you. That way, the new account would look active for a while. But then, when you tried to use your debit card and did not have enough money because $500 had disappeared, you would get hit with overdraft fees. The bank actually had a name for all these tactics internally. They called it gaming, which is a pretty twisted way to describe fraud. And they would cover their tracks too. If a customer had a phone number or email on file, employees would sometimes change it again without permission to prevent the bank from being able to reach them for satisfaction surveys. Because if you called someone up and said, "Hey, how do you like that credit card we opened for you?" and they said, "What credit card?" well, that would be a problem. The numbers are staggering. Between 2011 and 2016 alone, Wells Fargo employees opened roughly 1.5 million checking and savings accounts without authorization. Another 565,000 credit card accounts. And when they went back and looked even further, going all the way to 2002, they eventually found the total was closer to 3.5 million fraudulent accounts. Let that sink in. 3.5 million times someone's identity was used to open a financial product they never agreed to. You might be thinking, okay, so some fake accounts got opened. But did it really hurt anyone? I mean, they closed them eventually, right? Here is the brutal truth. It destroyed people's lives. Around 85,000 of those fake accounts racked up fees. We are talking overdraft charges, insufficient funds fees, annual fees on credit cards people did not know they had, and interest charges. In total, Wells Fargo collected about $2.5 million just from these fake accounts, money they had absolutely no right to. But the money was actually the smallest part of the damage. The bigger problem? Credit scores. When Wells Fargo opened unauthorized credit cards, they would run credit checks without permission. Multiple credit inquiries in a short time can tank your credit score. Then, when the fake credit card sat there unused, or when people did not pay the fees they did not know about, those accounts would go delinquent. More damage to credit scores. Some customers saw their credit scores drop by 100 points. Others lost 125 points. One guy named Aaron Brody, who worked for the Fort Worth Police Department, opened a simple checking account in 2012. Wells Fargo sent him a credit card he never asked for. He was told he could just ignore it. A year later, it had nearly $1,000 in late fees and other charges. He closed his account and refused to pay what he correctly saw as bogus charges. Years later, when he tried to buy a house, he found out his credit score had dropped by 125 points. He couldn't qualify for a mortgage. Another customer named Hanef had his car repossessed because Wells Fargo had signed him up for car insurance he didn't need and already had. The extra premium charges piled up, and when he couldn't pay them because he didn't know about them, the bank took his car. Getting it back cost him hundreds of dollars, and his credit score dropped by 100 points. Think about what a credit score means in America. It affects whether you can buy a house, whether you can get a car loan, and whether you can rent an apartment. Some employers even check credit scores before hiring you. A tanked credit score can literally change the entire trajectory of your life. And for Wells Fargo's lower-income customers, this was especially devastating. These are people who might have been barely getting by, and suddenly they're hit with fees they can't afford and credit damage that makes it even harder to escape poverty. Wells Fargo eventually admitted that the fraud had harmed customers' credit ratings and unlawfully misused their personal information. But the damage was done. Even after getting compensated, how do you undo years of being unable to get a loan or an apartment because your credit was trashed? So, you might be wondering, didn't anyone try to stop this? Didn't employees speak up? Oh, they tried, and Wells Fargo destroyed them for it. The bank had something called an ethics hotline, a confidential number employees could call to report problems. In theory, this is supposed to be a safe way for whistleblowers to flag illegal activity without retaliation. But at Wells Fargo, calling the ethics line was basically signing your own pink slip. A guy named Bill Bado worked at a Wells Fargo branch in Pennsylvania. He saw what was happening and knew it was wrong. In September 2013, he emailed HR to report that he was being pressured to open fake accounts. 8 days later, 8 days, he was fired. The reason they gave? Tardiness. Suddenly, this guy who'd been working there without major issues was supposedly late too often and needed to go. The termination went on his permanent record in the financial industry. Other banks wouldn't hire him because of it. His house almost got foreclosed. He ended up working part-time at a grocery store. A woman named Heather Brock was a senior business banker. She reported questionable practices and said she endured harsh bullying, defamation of character, and eventually being pinned for something I didn't do. She was fired too. Another former branch manager named Yesenia Gitron said employees would call the ethics line and then get fired for basically anything managers could find. Being a few minutes late, making a small mistake on paperwork. Anything. One former HR official at Wells Fargo actually admitted the bank had a method in place to retaliate against tipsters. They'd watch whistleblowers closely, looking for any tiny violation they could use as an excuse to terminate them. One whistleblower got so desperate that they personally emailed CEO John Stumpf to report that the sales tactics were wrong. Nothing changed. Later investigations by the Occupational Safety and Health Administration, yes, OSHA got involved because this violated federal whistleblower protection laws, found multiple cases where Wells Fargo had illegally retaliated. In one case from 2017, OSHA ordered Wells Fargo to pay $5.4 million to a fired whistleblower and reinstate them 7 years after they'd been fired in 2010. In another case from 2022, OSHA ordered Wells Fargo to pay $22 million to a senior manager in Chicago who'd reported price fixing and other illegal activities to the ethics hotline and management. The manager was fired in 2019. This was the largest individual whistleblower award OSHA had ever issued at that point. Even as recently as 2024, whistleblowers were still coming forward with allegations of retaliation at Wells Fargo. So the message to employees was crystal clear. Keep your mouth shut, hit your numbers, or get fired. And if you try to do the right thing, you'll get fired anyway. And we'll make sure you can't work in banking again. Here's maybe the most infuriating part of this whole story. Wells Fargo's executives knew this was happening. They knew for years, and they did almost nothing to stop it. According to an independent investigation commissioned by Wells Fargo's own board of directors, management was aware of these problems as far back as 2002. 2002. The scandal didn't break publicly until 2016. That's 14 years. The Los Angeles Times had actually published articles about Wells Fargo's aggressive sales culture and suspicious account openings as early as 2013. Federal regulators started getting customer complaints around the same time. Internal investigations at Wells Fargo had been finding evidence of fake accounts for years. But instead of fixing the broken system, the bank just kept firing individual employees. Between January 2011 and March 2016, Wells Fargo fired about 5,300 workers for opening unauthorized accounts. Think about that for a second. 5,300 people. That's not a few bad apples. That's a systemic problem. When thousands of employees across the country are doing the same thing, it's not because they're all individually corrupt. It's because the system is pushing them to do it. But CEO John Stumpf kept insisting it was just those employees who were the problem. In testimony before Congress, he said the fired workers did not honor the company's values, and there were no incentives to commit fraud. He claimed he wasn't aware of any overbearing sales culture. This was a lie. We know it was a lie because internal documents later showed executives had been getting reports about these issues for over a decade. Meanwhile, Stumpf was making millions. In 2015, his total compensation was $19.3 million, and Wells Fargo's stock was soaring because all those fake accounts made the bank look incredibly successful at cross-selling. Investors loved it. Carrie Tolstedt, who ran the retail banking division where most of the fraud occurred, called Stumpf a master modeler of values and visions. She retired in 2016 with an exit package worth around $125 million. The whole scandal finally exploded into public view in September 2016. The Consumer Financial Protection Bureau, the CFPB, which is a federal agency created after the 2008 financial crisis to protect consumers, dropped the hammer on Wells Fargo. They issued a $100 million fine, which was the largest penalty the CFPB had ever issued at that point. The Office of the Comptroller of the Currency added another $35 million. The City and County of Los Angeles added $50 million. Total, $185 million in fines. The news went national immediately. Suddenly, everyone was talking about it. Congress held hearings. John Stumpf was called to testify before the Senate Banking Committee on September 20, 2016. It did not go well for him. Senator Elizabeth Warren absolutely demolished him. She pointed out that while the scandal was happening, Stumpf had been getting richer and richer. She noted that he hadn't resigned, hadn't returned any of his pay, and hadn't fired any senior executives, just the thousands of lower-level employees. "So you haven't resigned," Warren said. "You haven't returned a single nickel of your personal earnings. You haven't fired a single senior executive. Instead, evidently, your definition of accountable is to push the blame to your low-level employees who don't have the money for a fancy PR firm to defend themselves. It's gutless leadership." She ended by saying, "You should resign. You should give back the money that you took while this scam was going on, and you should be criminally investigated by both the Department of Justice and the Securities and Exchange Commission." A week later, Stumpf testified before the House Financial Services Committee. That went even worse. Lawmakers from both parties tore into him. They called Wells Fargo a criminal enterprise and a school for scoundrels, and said it had a broken culture. One representative asked if Wells Fargo could be prosecuted under RICO, the Racketeer Influenced and Corrupt Organizations Act, which is normally used against organized crime syndicates. Stumpf, who'd been sitting at the top of the bank for 9 years, looked completely unprepared. One expert on corporate governance said he was like a deer caught in the headlights. On October 12, 2016, less than a month after the CFPB fines were announced, John Stumpf resigned. The bank said he'd made the decision himself. He'd been CEO since 2007, chairman since 2010. Now he was out. But he still walked away rich. When he left, his total compensation package was worth more than $130 million. You might think Stumpf's resignation would be the end of it. It wasn't even close. Tim Sloan, who'd been Wells Fargo's president and chief operating officer, took over as chief executive officer. He promised reforms. The bank eliminated sales quotas. They hired consultants to review their practices. They said they'd changed. But the revelations kept coming. In 2017, Wells Fargo admitted they'd been charging as many as 570,000 auto loan customers for car insurance they didn't need and often already had. Because these customers were paying for duplicate insurance, some of them defaulted on their loans. About 20,000 people may have had their cars repossessed because of charges they shouldn't have been paying. Also in 2017, the bank admitted it had wrongly charged 110,000 mortgage customers for missing deadlines when the delays were actually Wells Fargo's fault. In 2018, the Federal Reserve took an unprecedented step. They capped Wells Fargo's assets at their 2017 level and said the bank couldn't grow until it fixed its problems and improved its governance. This was the first time the Fed had ever done something like this to a bank. Also in 2018, Wells Fargo and regulators reached a $1 billion settlement over the auto insurance and mortgage issues. Tim Sloan, the new chief executive officer, ended up resigning in March 2019 after less than 3 years on the job. The pressure from regulators and Congress was too much. He was replaced by Charles Scharf, who came from Visa and Bank of New York Mellon. In January 2020, John Stumpf was hit with a lifetime ban from the banking industry. The Office of the Comptroller of the Currency also fined him $17.5 million personally. Carrie Tolstedt got banned for life and fined $25 million. In February 2020, Wells Fargo agreed to pay $3 billion to the Department of Justice and the Securities and Exchange Commission to settle criminal and civil investigations. $3 billion. The bank admitted it had collected millions in fees it wasn't entitled to, harmed customers' credit ratings, and unlawfully misused personal information. The total amount Wells Fargo has paid in fines, settlements, and restitution related to the fake accounts scandal and subsequent issues, over $4 billion. Some estimates put it even higher when you include all the legal costs and class action settlements. So, what's the lesson here? What do we take away from this whole disaster? First, it shows what happens when a company prioritizes short-term profits over everything else. Wells Fargo became obsessed with those cross-selling numbers because Wall Street loved them. Investors saw all those accounts per customer and thought, wow, Wells Fargo is amazing at getting customers to use more products. The stock price went up, executives got richer. But underneath, it was all fake. It was built on fraud. And when the truth came out, the bank's reputation, which had been one of its biggest assets, was destroyed. Even now, almost a decade later, people still associate Wells Fargo with the fake account scandal. Second, it's a reminder about toxic workplace cultures. When you create an environment where people feel like they have to choose between doing the right thing and keeping their jobs, you're going to get fraud. Not because people are naturally corrupt, but because you've backed them into a corner. Those 5,300 employees who got fired, most of them were probably good people trying to survive in an impossible situation. They had bills to pay and families to feed, and their bosses were threatening to fire them if they didn't hit numbers that were mathematically impossible to hit legitimately. The real criminals weren't the tellers and personal bankers. They were the executives who created the system, knew it was causing fraud, and let it continue for years because it was making them rich. Third, whistleblower protections matter. If employees could have reported these problems without fear of being fired and blacklisted from the industry, maybe the fraud would have been caught earlier. But Wells Fargo retaliated against whistleblowers so consistently that nobody felt safe speaking up. And finally, it shows why financial regulation matters. The Consumer Financial Protection Bureau, which led the initial investigation, was created after the 2008 financial crisis specifically to protect consumers from this kind of thing. Without the Consumer Financial Protection Bureau, Wells Fargo might have gotten away with it for even longer. Wells Fargo is still around. They're still one of the biggest banks in America. Charles Scharf, the current chief executive officer, has been trying to rebuild the bank's reputation since 2019. But it's been a long road. The Federal Reserve's asset cap stayed in place for years, preventing the bank from growing. They've had to replace most of their board of directors. They've restructured their compensation systems. They've supposedly changed their culture. Whether any of that actually fixes the underlying problems, that's debatable. In 2025, reports emerged that employees were raising alarms about Wells Fargo returning to high-pressure sales tactics. Workers said they were seeing commission payments increase and the same kind of metric-driven pressure that caused the scandal in the first place. The bank denied it, of course. But can you blame people for being skeptical? For the customers who got hurt, the damage is done. Wells Fargo paid out hundreds of millions in restitution and settlements. People got refunds for the fees they were charged. There was a $142 million class action settlement specifically to compensate people whose credit scores were damaged. But money doesn't fix everything. If you lost a house because your credit was trashed, getting a few hundred or even a few $1,000s in compensation doesn't change that. If you had to delay buying a home for years because you couldn't qualify for a mortgage, you can't get that time back. The Wells Fargo fake accounts scandal is one of the biggest consumer fraud cases in American banking history. 3.5 million fake accounts, over a decade of misconduct, thousands of employees who felt they had no choice but to participate, millions of customers harmed, and executives who knew what was happening but let it continue because stopping it would have hurt their bonuses. It's a story about what happens when greed runs unchecked. When companies forget that their customers are human beings, not revenue targets. When employees are treated as disposable resources instead of people who deserve to work in environments where they don't have to choose between ethics and employment. And it's a warning. Because Wells Fargo isn't the only company that operates this way. They're just the ones who got caught. So, the next time a bank, or any company really, starts bragging about how good they are at selling you stuff you didn't ask for, maybe take a step back and ask, who's really benefiting here? Is this company trying to help me? Or are they just trying to hit their numbers? Your financial life is too important to trust it to a place that sees you as nothing more than a statistic on a quarterly earnings report. And if you work for a company that's pushing you to do things that don't feel right, that are making you stressed or anxious or physically ill, that's not normal. That's not okay. And you deserve better. The Wells Fargo scandal proves that when the pressure gets too intense, when the incentives are too twisted, even good people can get pushed into doing bad things. But it also shows that eventually the truth comes out. And when it does, the fallout is massive. The question is, how many people have to get hurt before we learn these lessons and actually change how businesses operate? That's something worth thinking about. Thanks for sticking with me through this whole story. If you found this interesting or learned something new, consider sharing it with someone who might benefit from knowing how this all went down. And remember, always read the fine print on anything your bank sends you. You never know what accounts they might be opening in your name.